All right, personal finance gang, we're continuing our investment basics talk, and we're going to look at the three most widely quoted stock indexes that we have in the US. So, indexes and averages. The Dow Jones Industrial Average isn't exactly an index, but don't worry about that. So, if you grab or you pop to any finance website, the lead page probably has, hey, what's the Dow Jones Industrial Average doing? The S&P 500 index, the Nasdaq Composite. You look on the news, or you see something in the paper. It's likely that these three measures are mentioned. So it's good to know what these three measures are all about. And these are different ways to look and see, hey, how is the stock market doing? So if you want to know what's the stock market been doing this year, there are all kinds of different measures you can look at to see how it's doing, but these are three of the most widely quoted. So the Dow Jones Industrial Average is 30 big companies. That's all it is. It's an average of the prices, and it's calculated not very great. It's calculated the same way it's been calculated for over 100 years, and it's the most widely quoted one because it's been around the longest. If it was up to professional finance types, it would probably disappear, and we'd just look at the S&P 500 index. But anyway, so if you hear how did the Dow do, what you're really hearing is the Dow Jones Industrial Average, you're hearing it. How did these 30 companies do? So here, and the 30 companies do change over time. Sometimes companies fall out of favor, other companies get added. But here are the 30 companies in the Dow Jones Industrial Average right now. So you got big names that you know, like Apple and Boeing and Caterpillar. All these are big names. Coca-Cola, Disney, Home Depot, McDonald's. Not exactly what I'd call industrial, but the definition of this has kind of changed over time. Microsoft and Nike, Walmart down there, which is doing great lately, business with the virus and such. But anyway, so here's the 30 companies that make up the Dow Jones Industrial Average right now. And you can see year to date, someone says, how's the market doing? Well, how's the Dow Jones Industrial Average doing? It's down about 22% for the year. So that's all from coronavirus stuff. I'll show more on that coming up. So that's the Dow Jones Industrial Average. The S&P 500 index, 500 big companies. Different S&P stands for Standard & Poor's. So Dow Jones is the company that started this average measure. They're also the people that own the Wall Street Journal. Standard & Poor's is another big finance type company. They created and keep this index up to date. So these 500 companies, sometimes companies go in and out, and the composition of the index does change. But this is a better tracking of, hey, how is the market doing? This is 500 of the biggest companies in the country, not necessarily the 500 biggest, but 500 of the biggest. And these are, relatively about as safe as we get company-wise, maybe, I guess. But these are, again, 500 big companies. How did they do? So this is a better picture versus just how do these 30 companies do. If two of these big ones do something that could, be enough to move this average around, where it's going to take a little bit more to move these 500 companies around. One note, there are thousands of different companies that have stock that you can buy. Like I mentioned, there's 3,000 firms in the Nasdaq Composite. The S&P 500 index only has 500 stocks, but this captures 75 to 80% of the overall dollar value of stocks. So these are the big stocks, big companies. They have more dollar value in these 500 than in the next 5,000 or so companies. Then last on my little list here, we have the NASDAQ Composite. So the NASDAQ is heavily weighted towards technology companies. Companies like, used to be long ago, companies when they grew up wanted to go into the New York Stock Exchange, be listed on the New York Stock Exchange. Then technology companies came along and decided they didn't need to pay. You had to pay to be in there and meet certain requirements, and they decided they didn't want to do that. And so companies like Apple, Microsoft, and Google, those companies are in the NASDAQ, traded on NASDAQ, which we'll mention coming up. But anyway, so, or I guess we already touched on that, but the NASDAQ Composite is heavily weighted towards technology. So if you see changes in this, it may differ from the changes in the S&P 500 index, which does include some of the NASDAQ stocks. But again, this is more heavily weighted towards technology companies. So what I talked about, if you went to any old finance website, you'd likely see these three things here. I'm going to just pull this over in front for a minute. Here is Yahoo Finance, just the front page of Yahoo Finance with stocks falling, choppy session. But here we see there's the three measures we just listed there, the S&P 500 index, the Dow 30, and the NASDAQ Composite. So the S&P 500 and the Dow are both down, minus 0.75, minus 0.83. Technology stocks apparently doing a little better today, not down as much. There are a lot more indexes out there, but we're only going to touch on these three. So let me keep going on. Now, a couple more terms that you want to know. And these have both been in the news of late, and because we've had both of these in real short order here. If we say an investor is bullish, we mean that person is optimistic about the market. Someone who's bearish is pessimistic about the market. If we are in a bull market, we are in a period of rising stock prices. If we are in a bear market, we are in a period of falling stock prices. Well, sometimes we define a bull market. You don't have to remember this, just remember the rising prices. But sometimes we define that as when we've gone up 20% above a recent low, we're said to be entering a bull market. And conversely, if we drop 20% from a recent high, we're entering into bearish territory. Well, we were in roughly a 10-year bull market, 10 or 11, something like that. And then suddenly with the coronavirus, we are now in a full-fledged bear market with an asterisk there. But here's the last 5 years. So you can see here's this is the S&P 500 index. I didn't mean to do that. So this is the S&P 500 index, the S&P 500. There's the current level of this. It doesn't really, 2602. You need to kind of keep up with numbers for this to mean anything. Or I'll give you a number, relative that you can compare that to. Way back here in, let's go 2016, the beginning of 2016, the market was closed at, about 2,000, we'll say. And so it's up 30% over 5 years. Well, that's not actually that great when you consider compounding. But if you look, let's move along over time. That's what I'm doing with this plus sign here. And I kind of fell off my scale here. Real recently, we got as high as 3380. So significant climb there over 5 years or so. And then we just kind of fell off a cliff. That's the coronavirus. But then, so we were as low. Imagine you had 100,000 right here on, what's that date? I can't see that. February 9th. So imagine you had $100,000 on February 9th. Then here at the end of March 15th, so a little over a month later, you would have had about $6,400 or so, or $6,600. I think it was down 34%. Wow. Okay, so that's again a reason not to have your rainy day funds in the stock market, or to have money you might need in the near term in the stock market. But since that low of 2304, the market's bounced up by, I don't know, from that, maybe, I don't know, no, about 15 to 20%, somewhere in there. Not 20%, but probably in the 15% range or so without doing any math. But again, that's why we have things like this, or one of the reasons for having things like the S&P 500 index. How's the market doing? Well, here you go. This is one key measure of the market. Was sailing along great until the coronavirus came and then did a sudden plop. All right, so we were in a bull market. That's the rising. We entered a bear market with that big drop. Spread out over a short period of time there. Now, stock quotes, you can use a stock quote to look up what's the stock selling for, what would I have to pay for it, or what could I sell mine for. You need to know, well, this coming up here, but this ticker symbol to get a stock quote. But the bid is what you can sell for. So when you pull up a quote, you'll see a bid and an ask. The bid is what you can sell for. The ask is what you'd have to pay if you were buying. So here with this Bed Bath & Beyond quote, at this time you could, if you were selling, you could get $69.01 per share. If you were buying, you'd have to pay $69.49. Don't worry about this, but that difference, there's people that are companies that make a market in this different securities. So they buy and sell, and they make money on the difference there. Right here, they're making 48 cents per share. That's called the spread. And usually it's smaller than that. But I mentioned you need a ticker symbol to look up a quote or to buy or sell via your broker. And let me get back here to, I popped up Yahoo Finance. So suppose you were interested in Apple Computer. Their ticker is AAPL, but if you just started writing in Apple, you'll see there's Apple Inc., the AAPL, and there's, you see the bid 256.20, the ask is 256.49. This is a 29-cent spread there. Don't lose any sleep over that term, but that's actually still pretty steep. This can get down to just a few pennies typically, but the coronavirus has things all stirred up because things are moving so fast. If you notice, the S&P 500 index, what was it, down like 0.85 when just a minute ago? Now it's down a little over 1%. Well, that's not super fast because it had 10% jumps in a day. We had a down 10% day that looked like a roller coaster ride, and then we had an up 10% day. And I mean, anyway, so that's why these spreads are a little different, bigger here. The people making a market on these are running scared a little bit. So, but you need a ticker symbol, which you can find just a little abbreviation. You'll need that if you go to buy or sell your stock via your broker as well. You put in the wrong ticker symbol, you get the wrong stock. All right, so what type of order? We're not going to go in. There's a lot more order types. We're only going to talk about the most common, and I'll mention one more just briefly on the side here. But there's a type of order that's executed as soon as it reaches, or as soon as it can be processed, and that is known as a market order. So if the market's open, you place a market order. As soon as your order can be processed, you get the best available price at the time the order is executed. So there's different market makers out there. There's different markets competing for business. The time your order is executed, you get the best of those available prices when it's executed. That's whether you're buying or selling, you get the best buy price or the best sell price that's available out there. Now, market orders, like I said, we could look up the Apple stock price, and we see it's the if we were going to buy, it would cost us $256.49. Actually, this is probably 15 minutes delayed. That's what you mostly get when you have these free websites. Through your broker, you should get current info, but don't lose any sleep over that. But so we could buy Apple Computer stock, it looks like, based on this for $256.49. We enter in the info in our brokerage account, click buy, confirm, and then odds are we'll get real close to that. But there's no guarantee. It's possible, although highly unlikely, that while we're trying to buy, the price could drop or go up, or maybe there could be some great news or some bad news. Maybe we're trying to sell and suddenly Apple says we're shutting all our manufacturing plants right as you're about to click buy. Not likely, but possible. Now, one thing you don't want to do with a market order is place one when the market is closed and have it execute when it's open, because a lot can happen if you give the market more time to move. So I've got the lady here says, I just checked stock prices tonight after work, and there's the price she wants on her stock. Should she place a market order to be executed in the morning? The answer on that is no. Like I said, we're not going to go into this, but you should do something that's known as a limit order. The price could jump 10% overnight and make it to where you didn't want to buy, or all sorts of things can go on. There are order types where you can say, for instance, with a limit order, I want to buy Apple Computer stock, but I don't want to pay more than $250 a share. So your order won't get executed unless the price you want's there. And you can put all sorts of other conditions on that, but that's beyond us. But we're just talking about market orders. All right, so where do you go to buy stock? Basically, you have to have a brokerage account, but there are some app type things such as Robinhood, and there's a few other things where you can save money and do this invest with small amounts. I'll send you a note on those later. But most commonly you would go either through a discount broker or a full service broker. Now, discount brokers, E-Trade, Ameritrade are two of the big names there. Discount brokers, all they do is, you want to buy or sell stock or bonds or whatever, you place an order, they execute the order for you. They also have information available to help you make decisions. But if you have a question, is this a good idea? They're not going to answer. That's not what they do. All they do is execute trades for you. And they would have other things to help you out, make your life easier. They'll lend you money on margin, but that's beyond what we're getting in here. They'll have linked accounts where you can move money and all sorts of things. And probably have mutual funds too, but that you can buy. But discount brokers, the discount brokerage service is just, hey, we execute transactions for you. Full service brokers, on the other hand, will look at your portfolio and say, hey, you might want to reallocate this. You might want to sell this stock. You might want to buy this stock. If you have a question, you can call and say, hey, should I buy this stock? Should I sell this stock? And they'll work with you on that. So that's what you get from full service brokers. Buy and sell recommendations, help with your portfolio, and you can ask them questions. You're not going to get any of that from a discount broker. But, well, how much do these people charge? Discount brokers, this is a shocker. It's hard to find much that's free these days. But late last year, I guess, sometime in October, November, one of the leading discount brokers came and said, we're not charging anything for commissions. And then a couple other firms said, oh, geez, we can't have that. We'll lose business. And so other places are not charging for commissions. They do make money on where your traffic's steered and other things, but they're not. A lot of the leading discount brokers are charging nothing. So it used to be, actually way back, you might have to pay over $100 every time you bought or sold stock. And if you were a small investor with $1,000, you might as well not bother because the transactions costs were so high. Then we had the discount brokers, and we got $20 transactions, and then we started having people come in and doing them for $9.95, then $4.95, and then $2.95, and then, well, nothing. Okay, so discount brokers, you can find a place to execute your trades for nothing. So this is a really good deal for small investors. If you were a big investor and investing $100,000 at a time, $20 isn't not much percentage-wise, but if you're investing a few hundred, $20 of that percentage-wise can add up. Now, full-service brokers may charge you per transaction. So every time you buy or sell, could charge a flat, a percent of that. And or there are some accounts where they have basically a wrap account, and they charge you a percentage of the funds they're helping you manage per year. So maybe if they charge you 1% of whatever you have invested per year. I like the percent of invested funds fee more than I like the fee to trade contract. With the fee to trade contract, where the brokers get paid whenever you buy or sell, well, what's their incentive? For you to buy or sell a lot. So the more you sell and buy, the more they make. Is that necessarily good for you? No. Okay, because you're losing money. You're definitely losing money every time you buy or sell because they're charging you a fee. Maybe the investment changes you're making are great, but that's not another issue. So if your broker looked at your portfolio and decided you didn't need to do anything, well, they'd make nothing on that. So instead, they might come up with hey, here's a good trade. So I don't like that. Gives a bad incentive. I like the wrap account where you get just a fee to manage the overall account. So should you use a full service broker or a discount broker? It depends. If you plan to make your own decisions, definitely get a discount broker. If you need help with your portfolio, you definitely need to think about a full service broker. But if you're a small investor, the full service people, fees may be too high, and or they may not be particularly interested in helping you. If you got just a few $1,000, you aren't going to be a big money maker for them. You could also do both. You could have a full service account and a discount brokerage account. So it's up to you. We'll talk about, say you're a small investor and you aren't, don't have enough funds to get a full service broker invested in you. You don't know what you want to do. There are some mutual funds designed for people like that, and they will charge fees, but they'll be smaller than what you'd pay for this. You aren't going to get custom designed portfolios, but you get, sort of generic portfolios with, you can pick the fund which matches your goals and timeline and such. More on that later. So before you start investing, you need to think about, hey, have I covered, do I have my rainy day fund set up? More on that in a sec. Do I have money for everything else I need? So don't throw money into the stock market if you can't pay for your insurance this month or your tuition this month, unless you're doing something real small, it's just, playing around a bit. Don't start any serious investing in the market before you've got your other needs taken care of. You need to make sure you know what your financial goals are, and tied with that, what's your investment horizon. So if you're investing for 20 years out, that's a completely different story than if you're investing for 20 weeks out. So you definitely want to think about that. How do you feel about risk? Imagine that you had 100,000 and then a few weeks later you had 66,000. If that would freak you out and you'd take all your money out of the market, you might need to adjust your investment strategy. Taxes are a concern. We're going to talk later about some ways you can save on taxes for everyday normal people, some investment alternatives for us. And also you need to think about capital gains. If you hold a security in a taxable account for less than a year, you have to pay ordinary income tax rates on that. If you hold for more than a year more, you get a capital gains tax rate, which is a lot lower than your normal ordinary income tax rate. Then again, other people that have different situations. Is your income particularly precarious right now? Do you have other issues going on in your life? You know, everybody's different. So you need to consider these kind of things before you start investing. One more time, this is a promise I'd harp on this during the semester, but before you start investing, one of the things you want to have at least set up and partway in is working on that emergency fund. So establish an emergency fund, and you can say this with me. How much money should you have in that emergency fund? Ideally, 3 to 6 months of take-home pay. So this fun, non-fun pandemic we're having is an illustration of why it's good to have something like this rainy day fund. There are lots of people losing their jobs or temporarily unemployed, required to stay home, can't work from home, no money coming in, and it's not a good situation. So ideally, you aren't going to start out with this, but you want to work toward having that money set aside. One last note here on those rainy day funds. Where are you going to put those? Not in the stock market, like we said. So these are the account types we looked at long ago. You want the rainy day money or money for tuition in something like a savings account, a checking account, a money market deposit account, a bank CD. All these with the asterisk have federal insurance. You could put in also something like U.S. Treasury bills or a money market mutual fund. This is something that invests in short-term, relatively low-risk securities, typically pays a higher return than savings accounts, depending, and does come with some risk. One of these was one money market fund was having some issues, and the Federal Reserve's I think made noise that they will help guarantee some of these so people didn't start taking their money out of them. Oops. I don't know what happened there real quick. Anyway, so let's pause here, and I'll pick up with more of investment basics in the next video.